So the Federal Reserve just raised interest rates. And now let's just think about what that means. So what we're looking at right now is the regional banks index in the USA. So by definition, these are smaller banks. Generally, they have operations in one state or a handful of states. They're not national banks. And many of these banks, they avoid federal regulation by just focusing on a state. So then they're only liable for state regulation. And that also means that they get to avoid some of the more onerous regulations that get imposed on the very large banks. So we've seen in the last couple of weeks that several of these smaller regional banks have gone bust. And then there was the necessity to step in. And the Federal Reserve, the FDIC, and the US Treasury, they got together, they put together a package, and they've insured all banks' deposits. But that doesn't mean that they're suddenly back making money. And then we can definitely see here that we've had a big decline into the low a week ago, but then the regional banks have not rebounded. Now, let's just put this into perspective and look at the S&P 500 banks index. And we also had a big decline here. And it's not simply that the regional banks are not rallying. The S&P 500 banks haven't rallied either. So the pressure so far has focused on the smaller banks, but there's still a lot of uncertainty about the outlook for the bigger banks. And the reason for that is because the Federal Reserve has been raising rates now for a year. They raised them again by 25 basis points today, and they've basically said that they're probably going to raise them again at the next meeting. But the bond market is starting to price in the potential that there are going to be interest rate cuts. And that's before the end of the year. So we've seen this huge rally in the 10-year yield since the of the pandemic in 2020, going up from less than 50 basis points to almost 4 or just about 4.25. And since then, it's come down to about 3.5. Now you can also see that that's the region of the 200-day moving average. It's the upper side of the underlying range. And this is a really big question. Are we going to see yields continue higher from here? Or are yields going to compress? Now, this is basically another way of asking, is inflation going to be a problem that continues for the foreseeable future? Or is deflation a bigger risk? And then an additional way of thinking about that is not so much about inflation, deflation, but about an economic expansion or an economic contraction or recession. Because the bond market pricing in deflationary forces, that's pretty much the same as pricing in the potential for a recession. Now, when we think about the shape of the yield curve, well, we can definitely think about the fact the long end of the curve is still at a maturity of about 6 months is still around 5%. By the time you get out to 10 years, then yields have compressed. So this is a very sharply inverted yield curve. All the way from any maturity from 6 months out to a decade, then the earlier yield is higher than the next one. So what that is implying is that there's the scope for rates to move higher in the short term, but that beyond 6 months, there's a strong likelihood that rates will be lower. And that's suggesting that we are going to have a recession. So that's basically also what the Fed has pretty much said. Because in the press conference after the announcement, what Jerome Powell said was that uncertainty has gone up. Then he said that they're committed to ensuring that inflation comes back down to their target of 2%, And the preferred gauge of inflation in the USA is the personal consumption expenditure, and that's currently 4.7%. And when we then just look at the fact that it did not get up to exceptionally high levels like we saw the CPI. So this core way of looking at the inflation measure, it has moderated, but it has not come down a lot. And it has a fair way to go before it gets down to 2%. And then let's also bear in mind that for most of the last almost 20 years, inflation has not really sustained a move above 2%. So when the Federal Reserve is talking about killing off inflation and getting the measure back down, what they're really talking about is a really significant economic contraction. And the thing that I've had at the back of my mind, and I was just thinking about, well, what would be necessary to curtail inflation? Well, there are two things that helped to stoke inflation. The first was that the US government printed an enormous amount of money and then basically dispensed it to everyone in the country. So that massive infusion of liquidity directly into consumers' bank accounts, well, that was a huge spur that drove demand. And at the same time, we had interest rates at exceptionally low levels. So then at the same time, we had the large number of people who left the workforce. And because of all that liquidity, then companies were scrambling to find workers. So if we want to get inflation back down, we have to remove those factors. So then interest rates have to go up, liquidity has to get drained out of the consumer sector, and then on top of all that, the number of available jobs has to roughly equate with the number of available workers. So either the number of available jobs has to go down, or the number of available workers has to go up. Well, it's a lot easier for the number of available jobs to go down than it is to suddenly bring people back into the workforce, particularly if the older generation have retired. So until that happens and unemployment starts to rise, I would anticipate that the Federal Reserve is going to hold interest rates rather high. Because what I find especially interesting is that if we look at history and we think about the hiking cycles of the past, they don't go straight up and straight down. There are generally periods where they hold rates steady for a while. Now, in 2018 and 19, that really wasn't very long. It was only about 6 months. And in between 2006 and 2007, it was more than a year. So now we can think about what's likely next is that we're going to have one more hike, or potentially not. But then would interest rates come straight back down? The challenge here, and I think this is by far the most important factor, is that we have a sharply inverted yield curve. And the times when you have stress in the global economy are generally when the yield curve is surging higher. Well, it popped on the upside last week and it really hasn't moved very much for this week. But that's a good sized jump. And if we go back and look at history, well, in the early 2000s, we had an inverted yield curve. And then it wasn't really until about March of 2000 that the market peaked. But as the yield curve ramped higher, that's when we had the biggest selling pressure in the stock market. The yield curve went inverted right at the end of 2005, and it stayed inverted all the way through to 2007. But when the yield curve starts trending higher, it goes back above zero and then marches higher. That's usually when you get the worst of the selling pressure, which was also in 2007 and 8. So we had a meaningful decline in stocks last year, but now we're starting to see the yield curve moving higher. And what this suggests is that there is more risk, not less risk. And that's basically also what the Fed said today, that there's more uncertainty. And lots of banks are sitting on significant losses. And I think the easiest way to look at that is when we look at the total of negative yielding debt. Back in 2021, it was at a total of about 18.5 trillion. And then all those negative yielding bonds moved into positive yields, which means their prices went down. So anyone who was buying bonds with negative yields between about 2018 and 2021 is now sitting on a significant loss. And the only way to mitigate that loss is to wait it out. But that means that they've got these big red numbers sitting on their portfolios. And that also means that it's going to curtail their ability to make additional loans. It's going to curtail their ability to have a, a more vibrant business model. That restricts liquidity. Now, what I found especially interesting today is that the NASDAQ had initially rallied on the assumption that there would be that we're close to the peak in the interest rate cycle, and then it gave up all of the advance as we come towards the close. So there is the potential here that the tech sector has done really rather well over the last week, and that we're going to get a little bit of pause and consolidation here. There's been a great deal of enthusiasm surrounding the artificial intelligence trend, and Nvidia, for example, has rallied in an exceptionally vibrant manner, and it's still in the region of its highs. So even in a tightening liquidity environment where there are difficulties about uncertainty in the banking sector, and there's obviously the potential there's going to be a recession, then where there is a clear inspirational story in the tech sector is still capable of attracting interest. And these types of companies tend to do well in a lower interest rate environment, and they are being used as a proxy by investors as a way of betting that interest rates will be declining and that the strength of the trend in artificial intelligence will sustain them through a recession. And I think with that, I'll leave you for today. I'll wish all the best to all of you.